Hancock could not join us this morning, so I'll chair a meeting today. Welcome everybody to the Thursday, September 14th meeting of the Retirement System Investment Commission. I'm going to call the meeting to order and entertain a motion, if there is one, to approve the proposed agenda that each of you have in your packet and that has been posted. So moved. We have a motion. Second. And a second. So
participants are waiting in the lobby. To admit all participants in the lobby, press star.
All right. All in favor of approving the proposed agenda, please signify by saying aye.
Aye.
All opposed?
Aye.
Okay. All right. We have an agenda. You should also have received a copy of the June 1st, 2003 minutes. I trust you've had an opportunity to review those. Do I hear a motion to approve the minutes as presented?
So moved.
Second.
So we have a motion and a second. All in favor of adopting the minutes as presented? Indicate by saying aye.
Aye.
Any opposed? All right, so our minutes are approved. Mr. Hancock, I believe we're going to move into executive session.
Yes, ma'am. Yeah, a little bit of a kind of a out of order as to how we usually proceed today, Madam Chair. We'll have, in essence, on the agenda, you see two executive sessions. We have some matters to attend to where, because of some time differences that we need to go into executive session now. So the motion would be to proceed into executive session to discuss investment matters pursuant to SC Code annotated sections 91680 and 916-320, including specific matters related to the public equity and portable alpha portfolios, to discuss personnel matters pursuant to SC Code annotated section 30-40-70A1, and to receive advice from legal counsel pursuant to SC Code section 30-4-70A2.
We have a motion to move into executive session. Do I hear a second?
Second.
All in favor of moving into executive session, please indicate so by saying aye.
Aye.
All opposed? All right. If the staff would take the appropriate measures, we will move into executive session. I believe the audit committee met since our last meeting, so there is no report there. The Human Resources Committee did in fact meet, and I chair that committee. So I'll give you a brief report there. We met on Friday, September the 8th. We received updates regarding staff changes that had occurred since the May committee meeting from Mr. Hitchcock and Ms. Volkert. A current organizational chart was also provided as well. And then the committee receded into executive session to discuss personnel matters, including the compensation and the VC component of the compensation program.
There was actually, the audit committee did meet on June 13th, and the report had been uploaded to
Okay, I'm
Watchdog.
sorry.
So it was so long ago.
Incorrect.
It was like right after the last meeting.
Okay, thank you very much, Betsy. Are there any questions or comments? All right, hearing none, we'll move on to our CEO's report. So, Mr. Hitchcock.
Thank you, Madam Chair. First up, I have our annual budget recommendation and asking for approval from the commission in order for me to be able to submit our proposed budget to the governor's office, and then it will make its way through the legislative process. As I always like to begin anytime I'm talking about our budget, just the reminder that we are an other funds agency. That means we do not receive any general funds from the General Assembly. Instead, the appropriations bill simply authorizes us to expend trust funds in order to operate the agency. Along those lines, I have, in my capacity as CEO, I have not asked for an authorization increase since I believe it was either my first or second year in the role. And that was an increase that we actually received, and I'll go through it in detail with you in just a moment. But we're one of the few agencies that after that actually asked for an authorization decrease. And I did that over the course of over 2 fiscal years, and actually asked for a decrease of $2 million since that increase, or since that high watermark. And this will be the first time since then that I am asking for an authorization increase. And just to give the commission some background, the General Assembly passes as part of the appropriations bill cost of living adjustments for state employees. And for agencies that are supported by general funds, the General Assembly appropriates money in the annual appropriations bill in order to compensate for those cost of living adjustments. As an other funds agency, we don't receive any of those funds, nor two, do we get a automatic authorization increase, because for other general funds agencies, that money is then automatically plugged into their base budget for the next fiscal year, so they don't have to ask for that additional authorization. Since during my tenure, we have absorbed all of the cost of living adjustments without receiving additional funds or asking for additional authorization. So the increase that I'll talk about that we're asking for represents, in essence, the cumulative impact of those cost of living adjustments over that ensuing time period on our personal services budget, and then also the corresponding impact that has on employee benefits as well. So with that, I will proceed through the presentation. Our organizational chart, certainly happy to answer any questions that the commission may have about that. But as you see, really the impact here of what we've talked about previously of our smaller team model on the investment team. And this is the recent appropriations history. And as you can see back in FY17, this is the year where we asked for the additional authorization increase. Came back the next year and asked for a $1.5 million authorization decrease, which was the easiest and probably for the folks in the General Assembly most surprising budget ask ever. Followed up closely by in FY20 when I asked for an additional $500,000 decrease. Now where we find ourselves, having absorbed the cost of those cost of living adjustments over that time period, we are in a position where we do need to ask for additional authorization, and in order to meet the promises that we made in regards to our compensation program, and then which the goal of is to recruit and retain the best investment and both front office and back office personnel that we can.
Mike, just to be clear, this increase in what you requested, it reflects what, to pay for COLA?
It's basically it's the absorbed cost of the COLAs that we've received, when the General Assembly gives out a COLA to state employees, they don't give us any additional money. So we've absorbed all of those from over that time period. So this is just, in essence, catching us up with the impact of those from a percentage basis, if that makes sense.
Mike, remind me, because of our variable plan, does everybody get a COLA? Or
and
just, or,
And if you recall, when we adopted some changes to our compensation policy, recently.
yeah, yeah.
We've disentangled ourselves from the state COLA plan, so on a go-forward basis, we will have our own mechanism by which we do that. And that will be.
for everybody,
Well,
or just investment?
the back office staff are the ones who are eligible for, COLA-like performance increases, whereas the increases for our investment staff, the permanent increases are driven by how well they do in regards to variable compensation.
So does this increase include anything
It-
we're expecting to
Yes, sir.
pay?
Yes, sir. It's our projections over what we would need in order to, to pay for what we, we assume.
For this
that-
catch-up, plus what we'll need for next year
Correct.
anyway?
Right, yes, sir. And we may find ourselves, just depending, we may have a couple of years where we'll have to maybe ask for a little bit more, but
So Mike, you said the back office staff still receives COLA, but that is still funded by us?
it is, and it's market, and think of that as, increases for the back office staff are performance, market-based and performance-oriented. So we're, in essence, we're trying to make sure that we're competitive from a market perspective with our back office folks. And that drives their increases in comp, and our variable compensation program, as far as permanent increases go, our variable compensation program drives the permanent increases for our investment staff.
And Bill, specific to your question, the investment team did not receive the COLA.
Right. When we took when we instituted VCP, we took the investment team at that point off of the COLA system.
Okay. Thank you.
So we were at about 15.3 million. We're asking for a $1.2 million increase. 900,000 of that is in personal services, and an additional 300,000, which is the corresponding amount for that is impacted to employer contributions. And this is the justification for that, as we've already talked about, and the split between that 1.2 million. As far as FTEs go, we're authorized up to 51. We have 39 filled. However, we always have, to a certain extent, a little bit of, in the associate program, always have a little bit of a churn. But we're not requesting any additional FTEs, and we're pretty comfortable from a full-time staffing level where we are right now.
Mike, hasn't our filled positions over a number of years been generally around the low 40s?
It's been, yes, sir. It's been somewhere around 40 or,
And
40-ish.
what accounts for the reduction?
We've consolidated, we've been able to outsource some function. We've consolidated, like for instance, the recent shift to a smaller team model on the investment team. That's also accounted for the kind of the reduction in always on full-time staff.
And a few years ago, when we shifted from 18 asset classes to.
Sure, and the simplification of the portfolio that also has done that as well.
Facilitated that as well.
We do have two proviso requests. One is a continuing request that we have, and that is the exemption that we have from procurement regarding our relationship with BNY Mellon. We have been able to, through the years, to consolidate a substantial amount of services with BNY Mellon at significant cost savings. So we are asking for that to be continued. And also, kind of in concert with PIBA, we're asking that, and this would not necessarily take effect this year, but given our fiduciary audit, we are asking for the General Assembly to go ahead and put into, or at least consider putting in place, an exemption for us for the next round. We've done that in 2014, 18, and 22. Back in 2022, there was only one response to the RFP, and that was Funston. The cost was $400,000, and that's a cost, even though that audit is bid out by and controlled by the state auditor's office, that cost is passed along to us. And we have a, significant number of reviews that we are undergoing every year. So we're asking for a little relief from that. That's not, we don't necessarily need it this year because we're not due, but things that get in the budget tend to stay in the budget. So we're just kind of planning for the future on that one.
So it's an exemption, not
It's-
the fact that we won't do an audit, but it's an exemption on procurement?
Yeah, well, no, it's just it would be an exemption from, there's a requirement that be done every 4 years.
Right.
And it would be if that stayed in the budget, it would exempt us the next time that came around from having to do
I
that.
thought budget provisos expired at the end of the budget year. Is
Well,
this an exception?
they do, but once they're in there, they kind of.
Oh, okay. I got it.
They kind of
Yeah.
tend to hang around. So, but, I mean, it's not,
Strategic.
yeah, it's not anything that like I said, it doesn't affect us this year, but, it is
Get it in a year. Yeah.
it's a pretty significant expense. And,
And it's easier to put it in a year when we don't need to do it anyway.
right, that's right.
Well, back to this mosaic though, isn't that part of our risk mosaic? To have a fiduciary audit every 4 years?
I would like to work with the General Assembly to pick a different time frame for that. Because I question the value of that
Additional audit.
every 4 years. So,
Well, and I'd want another vendor, so,
Yeah.
I support some changes too, but
Yeah,
I don't want to delete that from our mosaic. I mean, some type of review from our mosaic.
well, and that's the requirement, right? The commission can commission that when and if it chooses at any time. And the commission can work with the state auditor's office to do that. This is, with all due respect, this is a hamster wheel.
Yeah.
This is a hamster wheel that we've been on continuously for, 9 years.
10 years, yeah.
Yeah, or almost 10 years, and it's not I would, with all due respect, I would question I'm not sure that the continued value that we're getting out of it is worth the $400,000. So,
I'll add one comment, or a question, I guess, is what is a fiduciary audit?
Ken, think of it as the kind of a comprehensive, audit of our policies and procedures, as it relates specifically or kind of as it ties to the fiduciary duty that we have to manage the trust on behalf of our beneficiaries.
Okay.
So it is broad.
So it's nothing to do with a financial audit.
It is not. No, sir, it's not a
It's
financial.
akin to an internal control.
more of a
audit,
compliance audit.
Sorta.
Yeah,
It's more policy driven.
It's a little bit more policy driven than that. So,
Yeah.
but it's a.
It's a governance audit.
Yeah, it's a governance audit. And we're,
Yep.
the last one, we were either at best practice or close to best practice on every area that they, I think the biggest thing was the ERM program. So was the area that I think that they had the most. And then but it's a significant amount of time and energy and resources.
Well, the advisory firm charges you $400,000 to do the audit. That seems pretty high to me, but
Yeah.
I know
The first time we had one of these,
in what they do, I think $400,000 is I compare it to other financial audits. of agencies or state or that just seems kind of high. That's my opinion.
Yeah, I think Reynolds was.
The first time we had one of these, we were a little bit astray and needed some validation and some outside help. I certainly don't think we need them with the frequency we have them now. I'm not saying we won't ever need another one, but I certainly annual or to me every 5 years seems like plenty. 3 to 5 years, somewhere in that range.
It probably shouldn't also be lost.
Just to make sure we haven't gotten astray.
They've been very complimentary.
Highly.
So it's not, this is not a situation of hearing somebody, criticizing and saying, we don't want to hear the criticism. They've been exceedingly complimentary about the changes that you all have made and some that the staff has made. As much as we love hearing praise, I think Reynolds makes a good point that maybe it's not the frequency that we need anymore, which was your point, Mike.
And I think, when we think about the efficient frontier of what can be, what else we can do, I think that's kind of where we are. And I think, rethinking this, and potentially a more either targeted or a different approach. It's just, it's like I said, it's a tremendous expense. It's a lot of staff time.
Okay.
It'd
be interesting if there's another flavor of engagement.
Sure, yeah, and that's
It
something
would be less invasive.
Yeah, and
but
this is,
maybe
again, this isn't,
more ongoing.
this isn't something that, this is just a, it has no impact for us necessarily this fiscal year, but, we're just trying to think ahead, so. And I have no guarantee that the General Assembly will, would entertain it anyway, so, but I can't ask for it if you don't let me, so. Right, because it's part of the budget package, so. And ultimately, a lot of things like this really sets the stage or creates the audience for a more permanent type change. So if we start raising this issue now, then I think it'll give us time to work with the General Assembly prior to the next engagement, to think about, is there a better way to approach this, if that makes sense. So,
Do we need to take any action on this?
you just approve the budget. There'll be a motion to approve the budget recommendation as presented.
Are we ready to do that, or is there
believe so.
more
Unless anybody has
information that you want to?
Unless anybody
Anybody
has
have
any
any other questions before we entertain a motion to authorize our CEO to submit this proposal?
Madam Chair, I'll just make one comment. Just being an employee of another state agency and being intimately involved in several other agencies, especially some other what we call, Mike referred to as other funds agencies, they're all asking for this kind of increase this year.
Yeah.
That 5% was probably the largest COLA we've seen in a long, long time. So everybody's asking for, at least the other funds agencies are asking for the same thing this year.
That's a very
Maybe
good
different
point.
amounts, but they're all asking. And the
Right.
General Assemblies, the budget committees are going to hear from everybody.
Well, and having absorbed it for so many years, I would think that would be favorably considered.
I would think so, yeah, and we've been very good stewards of
Right.
the amount that's been authorized, so.
Well, do I hear a motion that the commission authorize the CEO to submit a proposed fiscal year 2025 detailed budget substantially similar to the draft budget that has been presented for inclusion in the governor's annual budget?
So moved.
Do I have a second?
Second.
All right, all in favor of this motion, please indicate by saying aye. Aye.
Aye.
Any opposed? All right, Mr. CEO, you have your authorization.
Thank you. And that way I'll be able to pay y'all's massive salaries that you get for, next up, Madam Chair, we have a proposed framework for our asset allocation review that we'll be undertaking with projected completion in April of 2025. I think as everybody's aware, the commission established a discipline of reviewing the strategic asset allocation every 5 years. We did that and, made a some really substantial changes back in 2020. We've talked about before having reduced the policy portfolio from 18 asset classes to 5. And, we had 21 different benchmarks for that portfolio before we made the changes. And as part of the SI, when that was adopted into the SIOP, as part of that, the commission set a discipline of reviewing that strategic asset allocation every 5 years. Prior to that, we were on a schedule where we reviewed asset allocation every year. We made, as a result, commission a lot of times made very kind of minor or small changes that really didn't have much of an impact on return. And we found that through looking at that the utility function of that was really was not there. And then it probably was more, reviewing the strategic asset allocation that often was probably more harmful, did a lot more harm than it did good in regards to the policy portfolio. So our next.
Excuse me,
Yes, sir.
Mike. The asset allocation set for 5 years, but we review it every year. But are we allowed during that 5-year period, if something came up that we felt was significant or important enough to make a change, we could do that?
Certainly, yes, yes. Yeah, and there's language to that effect that's in the SIOP, right? And the SI, there's a saying that one General Assembly can't bind another, one commission can't bind another either, regardless. But there's there's language in there. Basically, it's the reasoning that you put in there in the SIOP is something along the lines of there would have to be some compelling reason or some factor that would impact, our ability to meet our overall goal, that we would change the asset allocation. So in consultation with the chair, our friends from Veris and Jeff, I developed this schedule for discussion purposes. I am not in any way saying that this is the final version of this. I would see this as a schedule that would grow and develop over time as we got closer and closer to really formally beginning that process. There may be other things that we would want to do in the lead up to that process as well. But I wanted to at least get the ball rolling in this direction so we can start thinking about what we would want to cover along the way. So as I see it, this is a living document. Again, these are just suggestions. This is to a certain extent. If we thought about this in Christmas tree terms, I would see this more as a Charlie Brown tree that we will, that will grow and develop, and that will hang more ornaments on as we get closer and closer. So, I think I've already gone through most of the components here. So, this is proposed that we do this over the course of 3 meetings. Again, none of that's not set in stone, and we can, have other items to consider or other things to talk about in the lead up to that. But the reason that, and we've talked about this earlier, the reason of starting it in the December, one of the main reasons in December 2024 from the scheduling purposes, that is when we should hopefully have both the latest actuarial evaluation, the 2024 actuarial evaluation, as well as the asset liability study from Veris. So, and I'm suggesting what are we, some things that we would cover at that meeting. One, I think it's important for us to revisit and always make sure that we have an agreement on what our goal is. What return are we solving for? And do we think, our current policy portfolio gets us there, right? At the end of the day, our job is, the way that I see it, and I think the way that we've expressed it is our job is to, attempt to earn a return that helps make the plan work. And by that, I mean, helps fund benefit payments for our current and future retirees. So do we feel comfortable with where we are from that perspective? I think it would be good for us to review the 2020 strategic asset allocation exercise. How do we get to the reference portfolio, the policy portfolio, and the ranges and the benchmarks? And then think of that in the context of what, if anything, has fundamentally changed. I mean, we're in a higher interest rate environment now. Does the slope of that, is the slope of that efficient frontier fundamentally different, where you're either rewarded or not rewarded as much for taking additional risk, right? And then, obviously, we would have the ALM study to review, thinking about how are we progressing towards our funded status. And when we think about those liabilities that we're attempting to service, how do those impact our risk tolerance? And then at the March 2025 meeting, I think it would be interesting for us to consider, when we think about that reference portfolio, right now, it's a 70-30 portfolio. But what would it be if it was 60-40, 65-35, or 70-30? And what types of policy portfolios would correspond to those different mixes, right? And that may be that we have not only different weights of the asset classes that we have, but we may want to look at portfolios and introduce new asset classes along those lines. And then, thinking about reaching consensus, on that reference portfolio, and then thinking about narrowing down kind of the universe of portfolios for the policy portfolio, that whether it's 5 or 6 or how many ever asset classes, that will give us that matches up with the risk in that reference portfolio. And then our April 2025 meeting, I think we need to spend some time thinking about benchmarks. Are the benchmarks encouraging what we want to see out of are they encouraging the formation of the types of portfolios and then respective asset classes that we're looking for in order to fulfill the role of that asset class? And also thinking about the reasonableness of the ranges around asset classes as well, and how that, if we think about if we have all the equity that we can in the portfolio and, the least amount of bonds and the most amount of privates, how does that affect risk? And what type of return what will we think about from that perspective? And then if we reversed it, and we had, we completely de-risked the portfolio within those applicable ranges, do we feel comfortable from a total portfolio perspective that that's the right way to go? And then look to approve the reference portfolio, policy portfolio, benchmarks and ranges, and then incorporate into the SIOP, which has to be adopted prior to May 1st of each calendar year.
Mike, what is the difference between the reference portfolio and the benchmark?
The benchmarks, within the policy the reference portfolio, when we show the performance presentation, that the 70-30, currently the 70-30 stocks bonds portfolio that's all the way to the left, right, which is kind of a risk reference for us. And then the benchmarks are, how we judge the performance of the various asset classes in the policy portfolio that, ultimately our implementation and manager selection is judged against. Okay. And I would, at this point, open it up for discussion. And like I said, not consider this to be a living document, not something that is set in stone, but, trying to think about when we would get information and when we would look to, have the information that we need in order to make the consideration and when we would need to adopt things by. So, but I would imagine that there's other ornaments that we'll put on the tree as we.
Is this something we were mandated to do or chose to do?
This is it's reviewing the strategic asset allocation is good practice, good governance practice.
Yeah.
And, so the commission in the SIOP has decided that we'll do that every 5 years.
Okay, so it's our decision. I just
Correct.
wondering
Yes,
if
ma'am.
it was a legislative mandate.
No, it is not. It's not. And the really what the legislature says that we need to do is we have to review our strategic, basically we have to review the SIOP every year, and we have to adopt an AIP, an annual investment plan, every year. So what we've done is we've just mashed those two together
Okay.
because statutorily, there's a lot of things that
Yeah.
overlap, so.
I just wondered how much flexibility we had.
We have, ultimately, this is, and just to kind of put it in context, this is my suggestion, but this is a decision and a process that is completely and totally owned by the commission.
Okay.
Right, so this is in essence, if we think about, kind of what's mine and what's yours, this is y'all's. So I guess you said y'all's instead of yours, but whatever. And the way that I like to think about it is, you've got those 4 boxes on the performance presentation. The reference portfolio, the policy portfolio really are owned by the commission. And then the implementation decisions and the manager selection, which is represented on the 2 boxes to the right, are you've delegated to staff.
Right.
So, and our job is really just to help facilitate your adoption of the policy portfolio.
We think 5 years, that's really, in your situation right now, we think that's the right cycle for you. The majority of the state pension systems that we work with do it on a 5-year basis. Now, there may be time down in the future if you've had a meaningful change to your benefit stream or assets, or the markets have changed dramatically, you might accelerate it. But we think, in terms of taking a long-term view, 5 years is the right cycle.
In our earlier discussions, it was mentioned that as a part of this process, we would also consider asset classes that we aren't currently utilizing. I presume that would be part of the Veris report.
It would, and I think that's part of that we could do that work. We could do that even in advance of this schedule here if we wanted to. Education on the different asset classes, what the risks were, what the objectives of each are.
Before December, so.
Before December, so we kind of hit
wise.
the ground running when
Right.
that time comes.
Yeah, and the other thing that I think you would see too is, you would see with the review of the 2020, you can, we would also spend some time talking about, this is what we had and this is what we
Right.
went to too,
Yeah.
right? Because there's asset classes in there that you don't see.
Hopefully, we won't go full circle.
Right, yeah.
We're back to 18.
We might have a new virus by then.
That's the answer. We're done.
Okay.
I
Okay,
have a comment, Madam Chair.
yes.
I think our current SIOP says something to the effect of, the board, the commission, which is what Mike was just saying. This is our major goal every year.
Absolutely.
The board shall adopt a plan that meets our needs, and the most important thing we do every year or whatever it says to do that is to set an asset allocation.
Right.
So I think this, our annual adoption of the SIOP AIP is the most important thing we do every year.
Which
So-
is what we're all gonna discuss next, I think.
Oh, well, that's the compliance. That's the.
So that's, so I commend Mike and others for putting this together, because, this 5th year that we're building up to might be more important than the 4th year or the 3rd year, because we're just approving or reapproving
Right.
as opposed to really considering changes. But yeah, I agree. Just right here, the big picture is, I do think, and I'm thankful for Mike in saying it, that this is a living document and it can expand or contract or whatever. But I certainly think we need to push the starting point back probably at least 2 meetings. Right here, review of the 2020 essay exercise, of course, that can be done at any time. No need to wait till December to do that. And then the first bullet, establish agreement on our goals. I think part of the 2020 review would probably be, well, what were the goals we tried to accomplish back back in 2020. I know we were trying to cut cost, simplify, other things, we didn't want the contribution rate to go below 40%. We don't want to increase contributions. There were all kinds of things we were talking about and that are all in the SIOP in some degree. So, that have all affected our decisions. So a refresher on that, and then later on at a subsequent meeting, we can establish them. Let's talk about them, identify them first. And then, and I don't know exactly how to work out, y'all know better than I do, but, waiting on the final or the December 24, annual investment return projections.
Yeah.
To do some calculations. I'm not sure we've kind of been preached to in a way. I don't mean that negatively, but the board, don't start thinking you should change things just because
Right.
1 year's projections change. And so I don't know that we have to wait until we get the December 24 projections to start running numbers. We will update them before April 25 for the SIOP, but so anyway, that's something I'm not sure how that'll work out, but that might not be something we really have to wait for.
Well, Bill, can I stop you right there for just
Yep,
1 sec?
yep.
Keep in mind, you will have just updated to a certain extent those projections in March of 2024 and
Right.
April of 2024 as well. So you'll only be like a couple of meetings out from having done that anyway. Because we'll get the 2023 in March, we'll come to you with projections based on the 2023 capital
Right.
market expectations. So we'll already have those in hand, when we're, by the time, whenever we start, we'll already have that in hand.
I think Bill made a good point, though, about maybe there are pieces of the process that are independent of numbers that we might be talking about at an earlier meeting, like
Sure.
September,
Sure.
Yeah.
Good.
and spread it over a longer period of time rather than concentrating a lot of it in one or two meetings.
I was
We
gonna
can
say,
easily do that. We could back the review up to,
The goal.
we can back the review up to
The goal review, yeah.
September or whenever, or June. I'm not.
Yeah.
Yes.
Yeah,
And I'm not saying all of the things I'm saying need to be changed, but in the March meeting, it says, consider impact of various reference portfolios. And that one I really love, because we've kind of chosen the most aggressive one, 70-30,
Right.
that we can. But it's consider the impact, and then it says at the same meeting, reach consensus on the reference portfolio. So we're gonna consider impacts on it, and then we're gonna reach consensus. Maybe there ought to be a deliberation phase between those two
Yeah.
discussions,
Yeah, I
which
think
might mean
spreading-
different
yeah,
meetings.
spreading that preliminary stuff out over more meetings, I think will give us a better product.
And then lastly, at the April meeting, that's the meeting we've got to approve the SIOP. We're still considering benchmarks, considering reasonableness of asset classes, approving things. But that's the same meeting we gotta adopt a 90-page document. Seems like there needs to be another month or so
Yeah.
to get that document written, reviewed, and then approve it. So, those are just my thoughts. I saw that's why I say probably at a minimum 2 months, 2 meetings earlier. And that needs a special meeting, I'll come to a special meeting.
Or just have a retreat.
But anyway, that's my thoughts, and I appreciate Mike for saying it's, what he did, what y'all have done, and saying it's a living document. But those are some of my living suggestions.
And there may have been a version of this that was a little bit longer, but that there was an influence of someone who likes to, when there's a good idea, likes to get it done. So just saying. this,
Watch the eyebrows.
this is not my, this might not
This
have
was
been.
not your original
This
draft.
might not have been my first crack at this, let's just say, and that I was influenced by others who like to get things done a little bit faster, so.
And then you were now being influenced by people who would like to spread the process out.
Sure.
Maybe we'll
One thing
find
at a
some
time.
middle ground there.
Well,
Yeah, we'll
well,
find-
it's a good draft,
Yeah,
though.
we'll find some middle ground, and like I said, we can, and this, I'm not, the one thing that we can keep, I can take your, like I said, I was just proposing this for discussion purposes, I can take your, your feedback now and over, in between meetings as well. And, we'll, the thing that we want to do is, like I said, this is your process, not ours. We want to make sure that we're operating in service of whatever it is that you guys want to do, as a body. And, we have there's no result that we're ultimately driving for in this at all. So, Jeff, you were gonna?
This is, I think, a fantastic outline. It does what we needed to do, all for having as much conversation, because this is, as James outlined earlier, 80-90% of the risk that we take. So this is the most important decision that gets made. The one thing I would say is we have actually not stopped talking about this for the last 3 years. So this is a formal kind of, we're looking ahead, but we've been talking about things relating to our persistent overweight to private markets. We've actually been having a lot of the discussions that will need to get more organized as we approach the need to make a decision. But I would just, the way I think of it, we've been having all of these conversations for a while.
Well, and for purposes of today, probably the most important takeaway is the right discussion topics are on the list.
Yeah, today.
How and when we choose to address each is, a work in progress, but it sounds to me like that we have consensus about the subject matter and that we're gonna be hitting on the right things. So thank you for all the thought and time that I'm sure went into putting that together, and we'll continue to look forward to revised versions.
That's right, sounds good. We'll, like I said, we'll make this a pretty treat by whatever it is.
All right, you're gonna talk with us about compliance.
Yes, and this is, one of the things that, and this is, something that I'm proposing, and again, this is really for your information purposes, and this is not, it's really, in taking the feedback from the Funston report that we got at the last Funston, under the last Funston review about exception-based reporting, and also thinking about some of the feedback that we've gotten, in regards to, ensuring that the commission is meeting its duty to review compliance with the SIOP on a quarterly basis. If you look over the broad structure of the reports that you receive and the content that we review and the presentations that we make at commission meetings, you're hitting all of those, you're really hitting all of those marks, but there's not necessarily just kind of one place where you can look to see, did we do that, right? So, this is something that I asked Robert and Michelle to put together, and to present as a kind of a proposal. It's, for this point, it's just really more for discussion purposes. What we've tried to do is break out some of the major parts of the SIOP and then assign some values to those, as we kind of see what the commission's done in regards to those, and reviewing those, so that, when you look at, and this is something that I would propose that I would include in the commission meeting materials. So, if this was in this commission meeting materials, you would see, like you would look at this dashboard and you would see, okay, at the 6/1/23 meeting, we got a yellow triangle under policy portfolio, because in essence, we've been overweight our private markets asset classes. And that's something that gives you, that's an exception that's something that can trigger you to ensure that that's something that you're paying attention to at this meeting. So, it's really meant to help you all, to help focus your attention on things that, that just better focus your attention on things that, we would submit that you should be asking questions about or be concerned about. I think it's giving you guys the opportunity to look at this, and then any feedback that you would have for me over the course of the next, in between now and the December meeting. This is not something that's required. It's just us, trying to further refine how we deliver information to you and make sure that, we throw a lot at you, and we realize that at every commission meeting. We want to make sure that it's, we're trying to drive towards it being digestible, so.
I like it. I think your dashboard approach makes it, more consistent and to the point, and it's clearly more efficient.
I agree with that.
It's a good visual.
And certainly there may be other areas that you would want to see us report on, and please feel free over the interim to reach out to me, and, that's things that we can think about adding as well.
There's always the success penalty that skews our
Yes.
application.
Yeah,
It is.
But, yeah.
Yeah, I think this is a great idea too, and very good. The one thing I'll suggest, we can talk about it, I don't know, it has to be on here, but our ERM in the audit committee, risk areas, maybe we could note the red areas, the currently high-risk areas, and if they've changed over time.
Yeah,
Or maybe they're in here somewhere,
Yeah, and I think-
one way or the other, but.
Area right there.
Yeah, and I think, that's risk report, so think of that as more what James does.
Okay.
Bill, let's talk about that offline, because I think because that changes so rarely, there might not be as much of that might be something that's better just for the audit committee to have possession over and report up, rather than, because the risk, let's talk about, let's talk about that.
You might be right, because they do change in frequently.
Yeah, I don't know if there's as much utility function in that as there, that because of the, but let's talk about that when we have some time.
Okay.
All right. We also updated our, every 2 years, we update the business plan. So we updated that. And you think of the business plan really as the operational plan by which we attempt to shape the organizational priorities to meet the strategic objectives of the commission. Mr. Chernick played a significant part in updating this plan. So, just wanted him to hit this real quick, and and I know it's out there for your review. This is something that we produce at our level, but we want to make you aware of it. And if there's any questions that you have about it, Andrew can certainly answer those for you.
I can do a very just high-level overview. As Mike said, so we typically talk about investments. Obviously, that's the main objective of the investment commission, but half of the organization supports the investment organization in back and middle office. Our ultimate goal is to allow the investment team to focus on investments only and give them the tools that they need to do their job to the best possible way. The way we view this business plan is kind of the way the investment commission or the investment team would review the annual investment plan. We don't have an AIP. This is our AIP. We're trying to gather objectives to help support the investment team. So this is a collaborative effort, through all of the organization, also ELT, an audit committee rolls into here very much too. So what you'll see here is our main objectives, and those trickle down to staff and departments' goals. They're broken into 4 categories: talent management, independent assurance, upgrading performance and liquidity, and further IT build-out.
And like I said, we just wanted to show this to you or ensure that you had a copy of this and the materials for for your situational awareness, but if you have any questions here or anything that you see in particular that, raises an issue, please feel free to reach out to Andrew or I, or we'll certainly entertain any questions.
Anytime, whether during meetings or after meetings, if you ever want to deep dive into any back office topic, we are happy to discuss it.
Thank you, Andrew.
Great, okay, Jackson.
Yeah, and, performance analysis.
He's up next.
Yep. Even lately.
All right,
Just in time, Mr. Bird.
yeah, you are up.
Thought he would be going for a while.
That's not an accounting here.
He loves that. He loves that business plan.
We're ready for our investment.
All right. Well, thank you, Madam Chair. Okay, I want to make sure I do the right button, not the wrong button here. So, as always, let me start with the high-level facts. First of all, during the year, we earned 6.83%. We very proud to say outperformed our benchmark by more than 1%. Three things I'd like to draw your attention to on this page. First is the fact that all of our longer 3-year, 5-year, and 10-year measures we are earning a return north of our 7% assumed rate of return, which we're very happy about. The second thing, all trailing time periods, we are seeing excess return. Won't always be the case over short periods of time, but we do aspire to have all of the longer periods of time demonstrating excess return. And then the third thing that I think is really important is I'd draw your attention to the net benefit payments. We are down on an annual basis to $266 million of net benefit outflows. This is 0.65% of what we see here as the total plan value, $40.6 billion. 5 years ago, just as a nice frame of reference, our 1-year net benefit payment outflow was $1.1 billion, which at the time was 3.6% of our plan assets. So that is a very meaningful change in the liquidity needs of our plan. So let me keep moving. This is the other page that may take me a minute to get through. A few things I want to make sure I call your attention to here. Hopefully I'm hitting the right button. Is the reference portfolio, which is the simple stock bond portfolio, had a fantastic year. That is about 70% of our portfolio. Frankly, it was only the 70 had a good year. The fixed income landscape has continued to be a little bit frustrating for investment grade bonds, but the public equity markets had a fantastic year. So that is, to me, the story of last year. The second thing I'd like to point out to you is our outperformance versus our policy return, as I highlighted on the previous page. Been very strong during the last 3 years. It's a period of time that is a recovery from a very steep drawdown in 2020, and then a very meaningful drawdown last year, and we've seen a strong recovery this year. So this has been strong performance during a period with a lot of different kind of market dynamics occurring. And then the third thing that I want to call your attention to, despite the strong year for the reference portfolio, the value from all three of the decisions over the trailing 3-year period of time. So we highlight the value from the decision to have a diversified approach. Then we have the portfolio structure decisions that we make, and then the quality of our manager selection on a trailing 3-year basis. Essentially, we are seeing almost equivalent value coming from all three decisions.
Jeff, can I ask you a question real quick?
I would love it if you did, Mike.
Thank you. One of the things that I think we see, and I think becomes quite notable when we see a sell-off in private markets, and I think this picks up somewhat in the difference in the value diversification, is we see the lag in private market
Yes.
markdowns.
Yep.
I think we tend to focus less on that when that lag, when public markets rally and private markets don't mark up as quickly, so is that something that we,
Are you,
yeah, is that something we're seeing, I mean, it's something we're.
yeah,
we're
it's
seeing
most
now.
definitely profoundly happening.
Right.
And I'll show that to you a little bit, how you see that in one more slide.
Sure, I just wanted to make sure that we highlight that there's a consistency in the lag and the markdown, or markup, as well as there is in the lag and the markdown.
Well, the point I think is really important is that really de-emphasizes the importance of a one-year return.
Yeah, sure.
At any point in time. Of course, we are happy, but that actually was a headwind for us this year because we were still seeing markdowns, and we have one less quarter of recovery in our private markets. We had one extra quarter of drawdown in private markets relative to public. So it tends to wash out the longer the time period you're looking at it.
Right.
So hence, I think it's just, when we have good data for 3 years, which we do, it's better to look at it on a 3-year basis than a 1-year basis. But I do want to make sure we never shy away from, this is going to be very volatile relative to this over short periods of time. We just know that.
Right.
Because those two portfolios are meaningfully different. So we highlight it when it's good for the reference portfolio. Last year we highlighted it. It was a nightmare for the reference portfolio. So these things can be very volatile. Our approach is designed, in the policy benchmark that we have, to not be as volatile as that 70-30 portfolio. So.
Thank you, Jeff.
So let me
Yes,
ask you,
sir.
so are we presently 70-30 or?
How do I go backwards? There we go. So we are not 70-30, but the risk level of the 70-30 portfolio, which is the reference portfolio, we set the reference portfolio and the policy portfolio to have equal expected volatility. So we are not in the reference portfolio. This is the portfolio the commission uses as a guidepost for me. I put us in things at times that look different than that, so we're trying to measure all of the incremental differences on this page. So we'll go left to right. This is the simple portfolio that we think has the same risk over long periods of time as our portfolio. This is the portfolio the commission adopted in April 2020 that we're living with for 5 years. I make our portfolio look different structurally than the policy portfolio, and then our managers execute on the structure that we have that is different than the policy portfolio. So we're looking at incremental changes between the simplest of simple and our actual portfolio. And down here, we're just highlighting how those returns between the two portfolios above them, how those returns diverge over time. So that's the structure.
So Jeff, because the
Yes, sir.
reference in the policy portfolios have the same level of risk volatility?
Expected risk.
Yeah, expected risk.
Yeah.
Does that mean because of the diversification of the policy portfolio, we're expecting more return?
Absolutely.
Okay.
100%. Otherwise, there is no benefit.
Right,
Yeah,
same expected risk.
Exactly.
You gotta do that for some reason. The reason's a little bit more return.
Exactly. You could reverse that and say, I want a portfolio with the same return, but I want to minimize my risk.
Yeah.
And that would also be deemed an efficient portfolio. But this is, we try to, every 5 years, set the risk for a reference portfolio that we think is an acceptable level of risk. And then what is an efficient expression of that is not limited to just 2 asset classes. It's like
So in James's chart today, we're going straight left, reducing risk.
Yeah, and a little bit up.
And a little bit up with a little bit more return. Yeah.
Exactly.
Yeah.
So we use a lot of analogies internally. I play golf. I would prefer not to be asked to compete against Tiger Woods with a driver and a putter. I would rather have a lot of clubs in my bag,
Yeah.
you know, so that kind of thing. So,
You're gonna lose either way.
and I did.
You get all the clubs and Dick's Sporting Goods.
Yeah, there you go. Yeah. I prefer to tee from a forward set of tees.
So that might be better.
All right, so these are, this slide shows us the performance of our asset classes. Long story short, if you look on the 1-year basis, 4 out of 5 of our asset classes are outperforming their benchmark. The exception being bonds, and I'll hit on that in a few minutes. On a 3-year basis and a 5-year basis, 4 out of 5 are outperforming. Private equity being the exception. As we've talked about before, our private equity portfolio, thanks to our team, has really been improving by leaps and bounds over the last 3 years, and you're seeing it in the returns now. The other line for portable alpha hedge funds, that is a method of executing the portfolio that I have available to me. We have been using it. Right now, that is 12% of the plan, and you can look over the 1 year, it really didn't help us. Very, very small amount of negative attribution there, but over 3 and 5 year periods, it's been very, very successful. To the tune of, if I go back, if I were to show you the 7 years since we've had it, we've added $1.4 billion to the portfolio as a consequence of choosing to implement that way. I am going to get real efficient with your time. Some of these slides are a bit redundant, but I want to make sure I hit on a few things. The allocation effect you can see at the bottom is negative, and this is a function of we've been underweight both public equity and bonds. Being underweight bonds has helped during the year, but underweight public equity did not help. And we are overweight our privates, which private debt, real assets, and private equity. Being overweight those did not help. So this is one of the things that if we were to not be looking at this over a 1 year basis, but over a 3 year basis, you would see the allocation effect has been positive 42 basis points, but in this particular instance of looking at the last 12 months, it has been negative. Moving on to implementation, we're looking at the ways that our portfolio looks different in terms of the composition of an asset class than what that asset class's benchmark is. So for example, we have listed real estate. What does that mean? That means REITs, publicly traded securities, which is not a component of our real estate benchmark. So we show it here because this is an implementation decision to look different. You can see here that these effects are by and large all positive. So then we get to manager selection. How have our managers executed versus the portfolio after, if we start from the implementation portfolio and then compare our execution, that isolates for us how have our managers performed. And here you see this has been very positive for the year. And if you look at this over a longer period of time, it's been 142 basis points annually over the last 3 years. A little bit, this year was a little bit better than that. So very pleased about that.
Can I ask a question?
Yes, sir.
It's, you don't have to go back to the slide, but it's about the implementation effect, I think. You know, we say we simplified our program, went from, 18 asset classes, sub-asset classes, down to 5. But I was looking at Verus's performance report, and they're reporting returns for 11 different currently asset classes or sub-asset classes. So,
yes.
So did we really simplify? And I'm not complaining, we're
yeah.
doing well.
Absolutely.
But,
great
I
question.
mean, we reduced it by a third, but not,
Yep.
I think it's a little misleading to say we reduced it to 5.
Think of it this way, Bill. If we left the portfolio the way it was, the commission is telling me to have a complex portfolio.
Yes.
When we switch to the simple asset allocation, the commission is instead saying, here's the simple portfolio. Use those complex things if they are going to add value.
Okay.
Does that make sense?
Yep,
So-
and our SIOP says both of those. It says
Exactly.
the simple portfolio will be a
Yep.
gravitational pull
Yep.
for you to
Exactly.
do that.
Exactly.
And then it also says, if you're gonna be more complex, you gotta make sure it's risk adjusted.
Yeah.
So it does address both. Okay, that helps.
Yeah, it's the thought is, complexities, the whole thought is complexity is supposed to add value.
Yeah.
Yeah, if, to the extent, because before it was always on complexity, and it was presumed that complexity adds value. Now it's presumed that complexity has to prove itself in order to add value.
Yeah.
Right, does that make sense?
Yeah, okay, good, thank you.
This is just showing all three of those effects together. I like this expression of it. This is all of the detail you have shown on one page that we just reviewed, shown on one page. You can look either horizontally and add up all the effects for an asset class, or you can look vertically, and that's how we organize those slides, just showing all of the allocation effects, all of the implementation effects, all the selection effects. But no matter how you do it, at the end of the day, the bottom right-hand corner, it worked. We outperformed by more than 1%. The sources of underperformance, I think, are pretty clear. We hit those early. The overweight to private equity, and frankly, all of the privates, underweight to public equity. And I've highlighted with the asterisk overweight duration. You may recall we talked about this at a prior meeting. We are underweight bonds, but what I have done with the bonds portfolio is moved duration higher, because that is the duration is the characteristic of the bonds portfolio that makes it diversifying to our other forms of risk. So even though we have a smaller footprint, I'm trying to make it behave like a little bit bigger footprint. But candidly, that has not helped in a rising interest rate environment.
Jeff,
But-
where does that show up in the attribution? Is that selection or implementation for?
So that is, that is selection. I'm looking here. So the selection effect, it's a good question. Thank you for asking. Negative 34 basis points. That is a function of, we actually had managers who performed pretty well, a couple of them. But here we have the effect that is, how did we implement? And in this case, frankly, you could consider me the manager, and that is a negative effect. But it's intentional. It is something that I don't expect to work all the time, but the reason it is there is to balance out some other risks in our plan. All right, and I think I should also point out in the top line, the bonds line, being underweight added value, but me trying to make the portfolio look like it had a larger weight undid some of that benefit. So that's the relationship between those two. Whereas the implementation would mean that what that's isolating is in the rising rate environment, nominal bonds do poorly. We have a healthy allocation to floating rate bonds, and those perform much better in a higher interest rate or in a rising interest rate environment. So that's more than in a nutshell, but thank you for the question. So then we move on to our customary compliance slide. We remain overweight private equity, although that weight has come down considerably over the course of the last year. We actually have made progress in reducing our overweights to private equity, private debt, real assets, and even our portable alpha hedge fund portfolio. That's come down by more than 1% during the fiscal year. So even though we are still highlighting for you here that we are out of the tolerance range in private equity, We have reduced that size of that portfolio by more than 1% during the year. And our total private markets, if we made progress in each one of them, that is obviously moving down as well. And let me close the show with risk. We have an interesting situation here. And I'm going to give you, the numbers speak for themselves on the page. I'm going to give you a little bit of a sense of how these have evolved over the course of the last 12 months. The reference portfolio volatility is unchanged versus 12 months ago. The policy portfolio, the implementation portfolio, and the actual portfolio have all fallen, and the last two have fallen more meaningfully by about 1.5% each. The policy portfolio has declined by about 0.5% in terms of its volatility. And we have seen a meaningful reduction. Oh boy, I did it again. How do I do that? Wrong button. The difference between our implementation portfolio and our policy portfolio measured here in our relative risk or tracking error, that has come down by about 40% from 2.4% to 1.4%. So we have really been tightening up the portfolio and trying to bring it back toward the target portfolio. I always like to show the difference between the forward estimates we have for risk in our portfolio versus what actually shows up in the volatility of the returns of our reference portfolio, our policy portfolio, implementation, and actual portfolios, owing to the treatment of the fact that some of our portfolio is valued on an appraisal basis. Those don't happen all the time, and therefore you don't tend to see the full volatility that we believe and we model to be present in those asset classes. So when we think about risk, we think about this, but when you see the actual returns, you don't necessarily see all of the volatility we believe is there, but we want you to understand what is the volatility of the return stream you see. So let me pause there and see if there are any questions. Mr. Conant, I want to make sure, you mentioned you had a question on the performance slides. I want to make sure that I've addressed it.
I must have misplaced those questions. So I've been trying to think through them.
You know where I live.
You've been working there, so
Yeah.
I think I'm covered. Thank you.
Okay, all right, thank you. All right, let me see if we jump through. We have the Veris performance deck in here as well. Back up. For anyone who, I think I thoroughly addressed my opinions on the peer rankings last time, so I don't feel we need to spend 10 seconds on that. The only other item that we have for you today in open session relates to the delegated investments. You've all received information on each of these, but we do kind of declare what we've done between meetings. We're in compliance with the between meeting limit for what we can do. But happy to address any. I'm actually happy for Brian Moore to address any question on any one of these.
Well, I've got one for Brian.
Of course.
Somewhere in our deck, and hopefully it wasn't an executive session, so stop me if it is, but we talked about our change in strategy in private equity, moving from more large cap to smaller
yep.
cap or mid cap, or maybe just smaller managers. Can one of y'all
Sure.
clear that up for me?
I've given our Brian and Evan, who's in charge of our private equity portfolio, a pretty ambitious goal. I want to see a portfolio structured to outperform our benchmark by 5% annually. And I want them to come back to me and tell me what we need to do in order to make that a reality. You know, we do some things already. We have a sizable co-investment portfolio, and very happy that that's going to deliver returns, but that's not going to get us all the way there. So we're stressing what are we targeting? What is the portfolio that we think gives us the best chance to achieve that goal? And frankly, it's not the portfolio you saw us have 10, 12, 15 years ago. It is a portfolio that is more targeted. It is not, the right way to say this is, it is not a portfolio that hides from the opportunity of the asset class. So what does that mean to me? That means it's an aggressive portfolio. We go down market where managers can buy smaller companies, own them for the appropriate period of time. And if you do that, we believe you have an asymmetrical return profile to the upside. So that's part of what's in that. I don't want to go too much further because I don't want to.
Because I think maybe even some of the selection of some of these are built into that, and something I think we'll talk about later, affected that too, or was part of that implementation.
And I think 10 years ago we were investing in a lot of the very largest investments out there.
Yeah.
And it just was not really the way to go after the returns that you can get in private equity in the most effective way. It was a little bit like we were overly concerned about having a mistake and not embracing the kind of animal spirits of the asset class that can really generate meaningful returns for you over a long period of time. So
if we're using less large managers, if that's an accurate statement, does that decrease our availability of co-investments?
It could, but that is part of what we underwrite.
Yeah.
Is how do these managers structure their portfolios? Is there co-investment? And if we have two managers that we think are equal and one will produce co-investment opportunities for us, that's a great chance for us to get away from all of the cost of private equity for those allocations, which just delivers a better net return for us. So that it matters to us. It really does. And in a horse race, we want to see the co-investment flow.
Yeah. Okay, thank you.
And,
Any other questions?
yeah.
Okay, I think we're now at the place in our agenda we're going to go into executive session. Mr. CEO, would you like to
And
propose the motion?
Yeah, and the justification for going into executive session is exactly what it was previously. So unless you want me to read it again, I certainly can. But
Okay, I have a motion to move into executive session.
So moved.
All right, we have a motion and a second. All in favor of going into executive session, would you please indicate by saying aye? Aye. Any opposed? Like sign? All right, we are now in executive session, and we'll give our staff the opportunity to make the necessary adjustments. We're going to take a 5-minute and there was nothing that was discussed in no decisions made in executive session. And I believe this concludes our business for today unless someone else has something that they need to bring before the commission.
Move we adjourn?
All right, I have a motion to adjourn. Is there a second?
I'll make it a motion.
Oh, you don't want to stay longer. No. All right, we have a motion and a second. All in favor of adjourning, please indicate by saying aye. Any opposed? Okay, well, thank you all for your time, and until next time.
Until next time.
Safe travels home.